Hello there. Thank you for joining me today. My name is Goya Subramanian. I manage a number of JP Morgan's rates trading activities, including European inflation trading. I'd like to use this opportunity to talk about what is fast becoming one of the most important issues that is facing monetary policy decision makers and by extension markets. And that is the kind of somewhat elusive concept of inflation. So, inflation remains at the core of monetary policy setting. The official adoption of inflation targeting only started taking place in the late 80s, even though a number of countries had experimented with it in the post-war periods. But about 30 countries now explicitly target consumer price inflation. And mostly that has been motivated by time periods where inflation has overshot meaningfully. The Royal Bank of New Zealand, who was the first to officially adopt inflation targeting, is a good example of a central bank whose economy had overheated meaningfully in the run-up to the 90s, with inflation hitting up to 20%. And when inflation targeting was introduced, it really did have a meaningful effect. Inflation dropped from a range of 0 to 20% down to a range of 0 to 5%. So it worked relatively well. And in aggregate, in the last decades, inflation has shifted lower across most major, developed economies from about 10% to about 2.5% or so now. But in a way, that inflation targeting perhaps has worked a little bit too well, because what we're faced with today is the inverse problem. There are many countries in which inflation is undershooting the policy target. The US is one of them, and you see a few others there. So one of the questions is why? Why is this undershooting? We thought we understood how to control inflation to prevent it from overshooting, but now we seem to have lost the ability to make inflation rise. And the historical framework for understanding inflation was related to the domestic labor market, and more specifically, this concept of the Phillips Curve, which related inflation to the unemployment rate, whereby it was posited that high levels of unemployment would correlate with low levels of inflation and vice versa. And that worked quite well. In the 1950s all the way to the 1970s, you did see this play out as expected. When unemployment was high, like in the late 50s, for example, that's the dark line, you saw that inflation came down meaningfully, and vice versa as we moved into the late 60s. But ever since the 70s and into the 90s, that relationship has started to fail. To the point that, if you look at, for example, the period of the late 70s and the late 80s, there is no more relationship between unemployment and inflation. And yet, the other thing that seems to be happening is that inflation is dropping. So not only does the unemployment rate no longer explain that, but inflation in addition is dropping. And so what you can see is that since the 90s and then the 2000s and beyond, that has continued to happen. So we've moved from 5% to below 2.5% in most of the developed economies on aggregate. So that leads to the question of where inflation went, and that's one of the issues that we're facing today. There's a number of different theories. Theories range from globalization to demographics, and we'll have a look at these to see whether they explain, that missing portion of inflation. Globalization is perhaps the best known one, and the one that most research has been done on. And clearly, it is intuitive that the advent of globalization has caused domestic price pressures to be very strongly linked to global developments through the import channel, through channels of kind of global slack, which can influence labor market competitiveness and so forth and so on. And the IMF in particular has done some amazing work on this, on understanding the long-run drivers of inflation. And what it did a couple of years ago is it looked at inflation across major economies and all of the kind of factors, global joint factors of inflation that could explain some of those domestic inflationary patterns. And what it found was pretty interesting. It found that about 50%, just over 50% of domestic inflation is actually explained by global factors. That's kind of what you see in this blue bar on the right. So a meaningful amount of domestic inflation is in fact global. And then that kind of makes intuitive sense. If you look at how that's evolved, that's been pretty steady actually since the 1990s. When it comes to producer prices and import prices, which is the yellow line, but it's increased gradually when it comes to headline inflation, which is the red line. So headline inflation has become more and more sensitive to global development. And then there are certain things that are less sensitive to global development. For example, domestic wages are less sensitive to global developments. So that kind of makes sense. And it's led to policymakers trying to disentangle what is local from what is global. When you do this, when you take the global effects into account, it does help explain, cyclical short-term inflationary behaviors better. So this table is full of numbers, but fundamentally what it says at the top is that the error, if you only use domestic variables in forecasting inflation, is up to 0.5 percentage point on average, and it's half that if you use global variables. And that's kind of led to, as I said, this focus on, what policymakers can control, which is, core inflation. So if you exclude some of these, volatile items that are influenced by global factors like food prices and energy prices, and you only focus on, core items that exclude those factors, then perhaps that is something that you can control a little bit better. So that is part of the explanation of what has been happening to inflation. But it doesn't explain everything. It turns out that despite that, there is an important component of inflation that is present in almost every country, but that is difficult to explain by anything that we can observe globally. It's not related to food prices, doesn't seem to be related to commodity prices, and yet it is quite disinflationary. It has weighed on inflation by up to 2 percentage points on average over the last few years. So that's fueled research into a number of deflationary theories, including demographics. So when people have looked at demographics as an explanatory variable for inflation, what they've looked at is the case of Japan, for example, where in Japan, it's well understood that the working age population is shrinking, the number of people above retirement age is increasing, and you've had a very disinflationary cycle in Japan. And that kind of has been true across G7 countries as the population ages and as the workforce declines, which is the red line, which is the working age population, which peaked in the early 1980s, and has been on the decline ever since, seems to correspond and coincide with a decrease of headline inflation. But it turns out that actually that perception is slightly wrong. It's not a complete picture of the forces of demographic changes. In order to understand it better, what we have needed to do is to split out the population into three pieces: the young, workers, and then retirees. And when you do that, what you find is that as the population ages, obviously the share of the young decreases and the share of retirees increases, but actually the share of the working force has been increasing over the last few years. And what's interesting is that actually that may be the explanation for that secular shift down in inflation in the late 80s into the 90s, because it may not be a coincidence that the peak of the working age population growth was also in the 80s. So what does that mean? How can we explain that? Well, one of the ways that we can explain that is that there's a piece missing in the traditional thinking. The traditional thinking goes that as people age and retire, they consume less, and so therefore that must be deflationary. And as people are in the workforce, they earn more, and therefore that must be inflationary. But it turns out it's the opposite. The reason it's the opposite is because effectively what's missing is the supply. As people are in the workforce, of course they consume more, that's absolutely true. But if you take a measure of production, of their productivity, for example, labor income, it turns out that they produce more than they consume. Whereas that's not true, obviously, for the young, and it's not true for retirees. They consume more than they produce. So what it actually looks like is happening is that as the population has moved towards a larger workforce, that's been net deflationary. And that creates some interesting thoughts and interesting kind of conundrums and problems for the future, because it's possible and likely probable that the workforce, the size of the workforce has peaked. And so as it shrinks and people get older, actually that could be quite inflationary. And indeed, when you apply that model that's slightly more sophisticated to try to explain longer run, trends of inflation, these kind of, secular deflationary trends, you find that it matches in almost every country. How about other things like technology and digitalization? Is that one of the reasons why we've had this kind of secular deflation? And there's a number of theories as to how that can happen. People consume more technology, it becomes cheaper. Technology actually allows people to, identify cheaper goods, and then, technology makes people more productive. Those are kind of the three theories. And a lot more research needs to be done into this particular area, but it does look like, that holds up. It is true that, digital goods have decreased in price much more quickly than consumer prices. And it's also true that digital services have become cheaper relative to other services. But, it's a relatively nascent field, and we need to do more research on it. So effectively, where does that leave us? It leaves us with, what looks like a reasonably complete understanding of inflation. The domestic price pressures are explained by the Phillips curve. The reason that stopped working is because we were missing some of the global factors that explain sort of cyclical price evolutions. And the bits that we're missing are probably explained by demographics and technology. So the question is that it? Is that a complete picture? And the answer may be that no, it may not be the whole picture. One of the things that we have not discussed is asset prices. We've only talked about consumer prices, and asset prices are explicitly excluded from monetary policy decision-making considerations. Both the ECB and the Federal Reserve, they care about it, but they apply macro-prudential rules to asset prices rather than targeting them outright. If we look at whether that's reasonable, it can absolutely be reasonable. If you look at the yellow line, it's the size of the Fed balance sheet, and it doesn't show any clear correlation with consumer prices, which is the Fed's target. But if you look at some other things, like for example, house prices, which is the white line, changes in house prices seem to be somewhat correlated, or they could be correlated to the changes in the size of monetary policy accommodation. And then when you look at equity prices, that seems like suspiciously correlated. So actually, perhaps there is something missing in our conception of inflation. And we can explain it in the following way. If you look at the expenditure of households by consumption purpose, that consumption is about 25% housing related. if you compare that to, for example, the weight of the CPI basket, that's only 15% weighted. So it looks like housing-related effects are about 7 to 8% underweighted relative to their consumption in the CPI basket. And that may lead policymakers to reconsider how CPI baskets are defined. The final thing that we should look at is also that CPI inflation, commodity prices, and house prices are measures of spot consumption. But actually, as we move through a lifetime of expenditure, we should also look at forward consumption measures. So those are measures of our savings and their ability to sustain us in old age. So investments are one of the things that we can look at. Now let's compare some of them. If you look at CPI inflation since the 1990s, it's increased by about 2 times. Commodity prices, again, have increased by 2 times. No surprise and no coincidence, given the impact of global factors on local CPI inflation. If we look at, for example, US house prices, however, they've increased by 3 to 4 times. So those are all spot measures. When we look at forward consumption measures, though, so those are measures of our ability to consume in the future, and we measure it by, for example, a bond investment in an ETF. Well, the price of that bond investment has gone up by 5 times. Equities has gone up by 11 times. And if you were to buy, maybe the purest expression of future consumption, which is an annuity for retirement in 20 years' time that will pay out in 20 years, that's increased by a factor of 14. So where do we go from here? Well, what it tells us is there's many uncertainties in the evolution of inflation. There's many factors that we don't understand: globalization, demographic composition, technology, and we don't know whether we're looking at the right price measures. Do they match consumption? Do they take into consideration changes in consumption over a lifetime? And that means that monetary policy targets not only are likely to change, but likely to be redefined. So what we know for sure is that we're far from done talking about inflation. That's why at JP Morgan, we spend so much time on inflation research. We have a research team that has expert knowledge in inflation markets, and that looks at both short-dated evolutions and long-run effects. And we have been, one of the major intermediaries in the bond markets. We've extensive capabilities on securities trading, including inflation, and our client base is some of the most diverse in the world. I've added in the presentation a bit of a schema to show you how we've distributed Spanish, Italian, French linker deals that we've been involved in, and we've fundamentally distributed them all across the world, across every investor type. So that was just a quick rundown of why inflation matters and why we're so focused on it. And we'd love to be able to help you with any of your needs. So please don't hesitate to reach out to me or one of my team, and we'd be very, very happy to help you. Thank you.